Hello everyone, welcome back to the channel. I'm photographer and today I have Genghis Khan with me. Remember in your school time where your teacher will actually always talk about this example, especially in English, economics, geography, history, they'll talk about this story of the subprime mortgage crisis.
You must also mention the every time parents will tell you about it, right? Your parents will remember the time, all that stuff.
Okay, maybe your parents never.
Oh.
Maybe your one did.
My parents didn't.
Oh, really?
Yeah.
I thought you mentioned.
That's why I never knew about the subprime mortgage. I know there was a financial crisis in 2008, but I didn't know about it.
Okay, I know you live under a rock. You have to tell
I'm
about
sorry, but my parents didn't tell me anything, okay?
We know you live under a rock. You have to tell us, okay? So today I'll be talking about the world's second largest financial crisis that happened in 2008, which is the subprime mortgage crisis. Let's talk about the mortgage crisis. So what is a mortgage first? Basically, I lend money from the bank.
Yeah, I just borrow, right?
I borrow to buy some stuff, right?
Yeah, then I put some collateral or something.
So I basically use, if I want to buy a house, then I use borrow money to buy the house. Then if I cannot pay up, then the house will get taken back.
Yeah, could be the house, could be other stuff as well, like
could
a
be-
car or something, right?
Could be other stuff also.
It's like your own personal assets, not your liquid assets, though.
I think you can use car as a collateral, like as long as it's tangible,
Yeah.
they can. As long as there's something to take.
Then it's called a subprime mortgage, right? So what is a subprime mortgage? What's the difference? So from the word subprime, right, you can realize it's like not the good kind of mortgage, right?
Sub as in subpar lah,
That means the bank borrow money to the people that is actually not eligible to borrow money.
But why?
Wait, I haven't talked about the context yet.
Okay.
So they borrow money to the people who they think may not be able to pay up. But then they charge high interest. A high risk, high return. So there's still like a sort of the profit motive there. Okay.
But this will be a little risky, yeah?
And now the context, which is why prompted what they prompted the subprime mortgage. So you know in the 2000s and 2001, the dot-com bubble actually burst, and then the 9/11 terror attack occurred in 2001, right? So the economy of US is like pretty crap.
You're going through a slump then,
Going through a slump then. So the government want to stimulate spending, right? Recover the economy. Lower interest rate. Lower interest rate means what? The demand for big ticket items like houses shoot up. Cost of borrowing lower. High interest, I need to pay more back. Low interest, I pay less back. But you know house, right? Need take some time to build. So supply limited. Wow, this is the price how go up.
Oh, because lack of supplies caused the demand to surge and the price to also surge.
So the price of house started to go up like siao. Then everyone see, wow, this house I buy now, good investment, you know. 10 years later the house price go up, I can sell no more.
Oh, because this is it's an illusion lah.
It's an illusion, but I'll explain why later. Okay, so more people start to buy house, then more people need loan. So the bank on one hand see, wow, if I don't give out loan, all the profit all fly away, cannot, so must give out loan. But not everyone can qualify, right? When they see the house, you know they say collateral, right? So I put the house as collateral. So the house price also going up. So that means the value of house going up. So even if you can't pay back, I just take the house, I sell, I still make profit. So the bank is like, confirm won't die.
Oh, it seems very safe.
Seems very safe. Because even if I cannot pay back, the bank just take the house. Then the house values keep going up. So the bank still making money.
Yeah, so you don't lose. It looks really good.
But this is not what the bank did eventually. So you know the bank, although lower risk, want to lower it even more. So what they did was, they sell the debt credits to investment banks, like the Lehman Brothers. So what do I mean? If I borrow you 100k, so you now owe me 100k, right?
Yeah.
But if I sell the debt credit to editor, that means
I owe to him.
you owe to him 100k. So he will pay me 100k to buy off your debt. So you need to pay back to him.
Oh.
And then the collateral, the house, is also belong to him. So if you can't pay back, you must give the house to him.
Okay.
So why? Of course, must have motivation to do this kind of thing, right? So what the investment bank did was, right, they divide one house into 100 portions.
Okay.
So if one house is 100k, right, I divide into 100 portions. That means one portion is only 1K. Then I sell it to 100 different people. So if you cannot pay up and I cannot sell the house, everyone only lose 1K. Instead of one person lose 100K.
Okay, no.
So you think the risk to everyone is lower. So more acceptable. And everyone will buy. And then to make it even more attractive, they did this. They repackage it with other financial products. Like they pack it with stocks. Then pack it with bonds. Pack it with other credits. So they look like, oh, this is a good financial product, you know. Even if your house part die, I still have the bond, I still have the stocks. If all this go up, you still make profit or break even. So they think even lower the risk even more. So the investment banks actually form all these financial products and sell it. So that's how they make their profits off it.
Okay. Seems like a pretty good session to stimulate growth. Like based on all these, it seems like it will be a lot of money being exchanged hands and stuff.
I haven't talked about the problem yet. Wait, the problem comes in later when Lehman Brothers become greedy. So, you know, even if I say this one good, then you think the company say, it's not good, you also will doubt it, right?
Yeah.
If you're an investor, one investment bank come tell you, oh, my product good, confirm make money one, you want buy or not?
Seems to be seems like a scam. You know?
So there are these rating firms that are rating these kind of financial products. So the three main ones, or the three biggest ones, Standard & Poor's, Moody's Investor Service, and Fitch Ratings. So they'll give rating to every financial product. Rate you this level, safe can buy. So they rated this kind of financial product by Lehman Brothers AAA. So it means low risk, high return, in simplest words.
Oh, okay.
So these are encourage even more people to buy. I need to introduce another concept called leverage. You know, okay, some of us here know Forex, right? So what's leverage? So if I 1 to 10 leverage means what? With $1, I can buy $10 worth of currency. Same for this one. So this Lehman's brother, greedy as hell. Look, this one, confirm make money, open up leverage. So leverage given was 1 to 32. So as long as the investor put in $1, he can get $32 worth of financial products. So that means what? If I lose money, investor lose $1, Lehman Brothers lose $32 together with the investor.
Oh, that's quite a huge. I don't know, it doesn't seem very high leverage.
Okay? Then now here is where the downfall, the chain reaction begins. So in 2005, right, you know, when the price keep going up, there will be a point where people no longer can afford. Even if I can get debt, I can get loans, I still cannot afford. One HDB, I sell 10 million, no one's gonna buy it.
It's too much,
Even if I can take 10 million off a loan, I'm not gonna buy it. It's not worth it.
It's too much,
Yes.
It's too much.
So in 2005 is when the too much begins. So when people can no longer afford homes, the price will begin to fall. And then you know the government, he lowered the interest rate to boost economic recovery. So many people spend money already, don't need recover already. So raise the interest rate. So all of a sudden, in the prices falling, then after that, the interest rate going back up, then it's like, you know, the real value of houses actually are falling, you know.
Oh, because now become unfavorable to have a house.
Yes, it's not unfavorable to own a house. And then the real value of that actually increase. Because as your house, as the value of your house go down, the value of debt is going up also, because interest rate is going up.
Oh.
So initially, I agreed was 5%, but now I raised it 10%. Because subprime mortgages, the interest rate is fluid. I can adjust it anytime.
I see.
So initially I loan 100k, I only need to pay extra 5k. Now I up it to 10%. I need to pay extra 5 more k more.
So you owe more, at the
Yeah.
same time the value of your own, whatever you have,
It's
decreases.
decreasing. So this actually motivated a lot of people to return their property to the bank. Cannot afford it, take it back. Then now how? The investment bank get the house from the bank. Like, crap, nobody want to buy house. Then how? Then the house just stay in the hand. Then cannot exchange the money. Then the what? The investor lose money, no? Cannot get the money back. But then if they don't open up leverage, you'll be fine. Because it's just the investor losing money. Although it's kind of busted to say this. But it's like the Lehman Brothers is not affected. But it's just because they open up leverage.
They lose 32 times or whatever the investors
Yeah.
are losing.
The investor lose $1, I lose $32 together with them. So how? Everyone just keep dying.
Oh, there's no way out, right?
There is actually legit no way out.
It's like an endless pitfall.
Exactly.
Oh no, it's like that basically Loki falling. You know, you got see the Doctor Strange and Loki.
Yeah.
I didn't see that, but it's okay.
I have been falling for 30 minutes.
So, there's this funny thing that Lehman Brothers did. They bought insurance for the financial product.
Uh-huh.
You expect me to save it, right? Okay, let me explain how the insurance works. So insurance work like this. If I buy it for this financial product, so if it's doomed and I no money to pay the investors, then the insurance company will come step in and pay the investors for you.
But this is a lot of money, yeah?
But you see, I take, then I split in different portions. I repack. I split again, repack. So no one knows how many times Lehman Brothers split and repack. So no one knows how many different portions did he lose money on. So what happened is, right, Lehman Brothers bought insurance from AIG, which is a huge insurance company from US. So at the end, AIG pay until cannot pay already. Bankrupt with him. But then the US government, to prevent further economic damage, bailed AIG out with 85 billion. But cannot bail Lehman Brothers out, They don't know, lose how many 100 billions already. Cannot. Not enough money. I bail out, later US government also die inside. Cannot save.
But oh wow, that is a huge problem, to say the least.
Yeah, so that's exactly what happened. So in the day, September 15, 2008, when the stock market just opened, when they reported bankruptcy, 43% of the stock market value evaporated. So imagine one day I have $1 million in my stock market value. 5 minutes later, declare bankrupt. Shrink by 43%, so I'm left with 570k.
Oh,
Oh.
that is.
So fast.
No, there's a huge problem with that, right? It's too much money.
Exactly.
Lost.
The market just shrunk by 43%, about half.
Oh.
So that's basically like the whole story of Lehman Brothers. But just to give you a peek on how successful they were, in 2007, in just 1 year, they recorded 60 billion in revenue and 4 billion USD in profits. And their peak share price was $86 per share.
Oh.
And they had assets worth 639 billion.
Wow. Holy shit.
I think that's 3 times Elon Musk, right? Is it? Half of Elon Musk.
I don't know, but it's a lot of money.
Yeah, but it's a lot of money. I mean, you have that much money just digit. It's just a number. It doesn't matter anymore. Okay.
Yeah.
And at one point, just a new entrant to the company has salary of 150k per year.
Oh, that's pretty
A
high.
new entrant?
Yeah,
Is there like
100.
any requirement to be a new entrant?
I mean, as long as you can enter Wall Street, you can get into this company. So 150k as a new entrant. You work for maybe 1-2 years, you go into managerial position, 500k at least.
Wow, that is huge, 50k.
Once you enter the director, 10 million and above.
Huh?
Wow.
And
So
how
the-
many directors are there?
Quite a few.
Wow.
So the boss, the big boss, yearly salary, 89 million.
Huh?
Wow. That is a lot.
Yes. So just another side interesting story. In 2003, the descendants of the slaves that the Lehman Brothers once owned actually sued the company.
Oh.
But the funny thing is, not even owned by the Lehmans anymore. So you want to find, you go find the Lehman family lah. Find Lehman Brothers for what? Not even owned by Lehman family anymore.
Yeah, that's true.
Ooh, yeah,
Because I'm finding trouble with like a legacy which isn't owned by the
because
people
company no all the brothers died already,
Exactly. And then another thing is, before bankruptcy, AIG and Lehman Brothers actually contacted Warren Buffett. Because Berkshire Hathaway is the company in Wall Street that is known for always having money, regardless of what shit they are in. But got rejected. So that's basically how the whole problem began. The Lehman Brothers. There are
so
4.
this is how greed can really
Yeah.
put you in a bad position.
If they didn't open up the leverage, they would still be alive. So unfortunately, they opened it up, and in 2008, the company of over 100 years history just collapsed.
Oh, that sucks, honestly.
Yeah. Okay. But then, any idea on what's the world largest economic crisis?
Great Depression?
The Great, yeah, probably the Great
Depression?
Nope.
No?
It's the 2019 COVID-19 pandemic driven economic
yeah.
Yes, so that actually quite greatly affected our lives. So about that, I'll talk about it next time. Thank you and see you next time.
After trading lah.
Basically. Hey, stop giggling.